The SEC Chair Gary Gensler has said he wants to take a look at the ESG business in general and how something kind of gets into or out of this ESG bucket, because there's not a lot of agreement on what exactly constitutes that ESG bucket. So there's a feeling that the first round of ESG metrics by some people really didn't get the job done. And we sort of need to advance this conversation about what is and is not ESG. In your opinion, is there going to be an attempt to more carefully define what ESG is in 2021, with or without the SEC prodding you?
Yes, Bob. I think the general heightened awareness on what qualifies or constitutes an ESG type of product is both needed as well as, from our perspective, very desired. And even within the broad spectrum of ESG products, you can have lighter green or darker green type of products. And typically the way we encourage investors to think about it is you have broad benchmark products such as S&P that really, give exposure to the broad-based market, but through an ESG lens and utilize good non-financial or environmental, social, and governance-related data points to construct a portfolio that is very holistic and can serve as a building block. And then on the other hand, you have more thematic exposures. You can have clean energy type of ETFs. You can have electric car type of ETFs. You can have specific themes that in and as themselves track a specific theme that could qualify as an environmental theme, or it could qualify as a social theme. And so there isn't that much consensus in relation to what is ESG. However, that heightened scrutiny and heightened awareness will lead to a heightened and elevated understanding of investors, and that, in our view, is very much a good thing. And we, as a product provider, as an asset manager, want to be here as a resource to help in that education process, to help with the transparency that is needed for investors to come to their conclusions in terms of which type of product is right for their specific portfolio and their specific purpose.
Yeah, Jennifer, you want to weigh in on that? I know Vote is not specifically in the ESG category necessarily, but you're in the ESG business. Would the whole industry benefit from a little more consensus on what exactly constitutes ESG? Because obviously the SEC seems very interested in this question.
Yeah. I think to Arnie's point, it's things are evolving and things evolve. And so our perspective on this is that sometimes for investors want to jump to the answer. They want somebody on their behalf to make these decisions. And so a lot of the ESG products that are out there to date, they take the weight of a company down, or they screen out potentially bad actors. And our view and what we're trying to do at Engine Number One is advance the ball a little bit and invest in these companies and help to transform them and drive them in the right direction. And so I think any degree to pin down a rating system or a category to a point in time is a little bit challenging. And in this space of linking, the social and the climate and the governance and turning them into economic factors that we can all use to make decisions, I think more conversation is great, but I think we're going to see a lot of evolution. In our view, is people want to be active, but they also want to drive transformation in these companies. So with Vote, for example, at Engine Number One, you're tracking the index, you're not tracking a custom index, and then we'll be active owners to drive these outcomes at these companies.
Yeah, I've been of two minds on this. And for the first couple of years, my thought was this is just all over the place and nobody can agree on anything. But now I'm sort of the mind that you should allow, as long as people clearly define what their goals are, what they're doing. I don't know why you would try to pin it down to some kind of specific formula. I don't necessarily think you can even do that. So my own thinking has evolved on that front. Arnie, let me just move on and ask you, the big knock on ESG in general has been, other than it's broad and hard to define, it tends to mimic essentially a big cap fund with a quality bent. So if you look at USSG, which you run, it's 20% Microsoft and Alphabet, and it performs very close to the S&P 500. In fact, within a percent or so. How do you respond to that criticism that you're essentially mimicking big cap quality funds?
Oh, Bob, I actually wouldn't see it as a criticism at all, personally. When I think about USSG as well as S&P, so both the comments go for both in the same way. Same for our small cap fund, SMLE, or the mid cap fund, mid-E. The whole idea behind those funds is to have an investment and profile, a risk and return profile that is extremely similar to the non-ESG benchmark of their respective segments. So when we look at the construction methodology, for example, of our USSG portfolio, the idea and the intent behind it is to have a roughly sector-neutral approach, but with significant elevation of the environmental, social, and governance-related profile. Similar for S&P, there we don't look at sectors, but we look at industry groups. So we are a little bit more granular than for USSG. And again, we look at every industry group, which are the top performance from an ESG standpoint of each industry group, and include those in the portfolio. The outcome really is, and the intent of those portfolios is to give investors something that they can use as, let's say, an S&P 500 ETF replacement, but elevate the ESG profile and not have to change, let's say, the investment process, but can do that as a plug-and-play type of solution.
Yeah. Jennifer, you want to weigh in on that? I mean, my point is, the ESG people or the investors always bring this up to me. Bob, the S&P is up 14% this year. The average ESG fund is up 14% this year. Arnie's, reply here is yes, but we own slightly different things than the S&P 500, so we're getting an equal amount of performance with a better ESG tilt. Is that the right way to look at it, or do you have a different way to look at it?
Yeah, I think anytime you tilt off a benchmark, you will have under or over performance. And I think the legacy first generation ESG rating systems, some years they're above the index, some years they're below. And so I think our view at engine number one is over time, we can work as investors maybe less with rating and screening systems and more understanding the fundamentals of each company and financially understanding how what they're doing on governance and workforce and climate affect their long-term return. But I do think that transforming businesses and industries to take impacts into account, it is a long game. It's not something where you should be judging that on quarterly performance. So I think that's an important question for investors, and that's why for engine number one we went with the strategy we did with Vote, where it is the index, and if you're owning those shares, we can then be very active and activist in helping those companies transform over time.